Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. Your weekly fix of local and international news for investors and traders alike. These are the stories that really caught my eye in the past week. Welcome to a Supernatural Stocks podcast after a ridiculously busy week of company announcements on the JSE. It really was tough to decide what to focus on, so I decided to follow my stomach and I chose food. Now, of all the industries out there, food manufacturing is obviously one of the most important. And there are quite a few companies on the JSE that operate in this space, and we did see some results from the sector in the past week. So I'll kick it off with RFG Holdings, which is a lesson in the importance of price increases for these types of businesses. Even when the consumer environment is weak, not putting through increases means opening yourself up to a very painful double whammy of lower prices and poor volumes anyway. Now, volumes are harder to control or even influence, so companies are forced to try and recover input cost pressures through price increases. The other important lesson in RFG is the usefulness of international diversification. This does tend to smooth out the numbers and therefore reduce risk for investors because different parts of the business will perform at different times. Now, for the 6 months to March 2024, RFG Holdings reported group revenue growth of 3.2%, which certainly isn't exciting, but is much better than would have been the case if RFG was only focused on exports, because international revenue fell 8.6%. The regional segment, which is mainly South Africa, that was up 5.8%. Now, volumes fell in both segments, but the key difference here is that pricing was a positive 10% in the regional segment and minus 6.5% in the international segment as global pricing softened. It is easy to assume that South Africa is always the problem and international businesses always do well, but life actually isn't that simple. And the particularly impressive thing at RFG is that the company still managed to expand its operating margin and EBITDA margin despite the modest revenue growth, with both segments experiencing higher margins. Headline earnings per share, or HEPS, that was up 20.7% as a result. Now, the share price is up more than 31% in the past 12 months, but it has found itself trading in a stubborn range this year that it is right on the cusp of breaking out of. At the time of recording, RFG is trading just below the 52-week high. The share price is still below pre-COVID levels, so there is room for it to move higher if it does manage to break through the stubborn resistance. It certainly won't be at all-time highs in that case. Now, for more active traders, this may well be a share price chart worth looking at, especially if you love range trading. Speaking of share price charts, there is no technical pattern, or at least none that I know of, to describe what we've witnessed at Quantum Foods. With much activity on the share register as major shareholders fought it out for higher stakes in the company, it really has been chaos. And the chaos started in March this year and took the share price from around R4.50 to a 52-week high of R18.50, a spectacular rally of over 4 times. It's now back at R10.30 at the time of recording, a cautionary tale around chasing M&A activity. We see it quite often in the market that a share price climbs rapidly in the hope of a massive offer coming through, only for the offer to not materialize and the hype to then just fizzle out. This can hurt really badly for those who tried to chase the deal, so be careful. It's called a cautionary announcement for a reason in the market. Looking at the business itself, Quantum reports based on 4 segments. The largest by far from a revenue perspective is animal feeds, contributing roughly half of group revenue. It only makes as much operating profit as the eggs or farming segments in a normal year though, but the concept of a normal year is quite tough to put your finger on in this sector, and especially at Quantum Foods. You would be forgiven for suffering from whiplash when you read these numbers. In the 6 months to March 2024, the eggs segment made operating profit of R57 million, but farming lost R67 million. Now, if you look at the comparable period, it was completely the other way around. The situation was reversed, with eggs making a loss of R78 million and farming a profit of R58 million. Thank goodness for animal feeds, which seems to be the dependable kid in the family, with profit of R54 million in this period and R49 million in the comparable period. And for those keeping count, the 4th and final segment is other African countries, which also swings wildly. Perhaps the most interesting thing about Quantum is revenue in the eggs segment fell by R266 million year on year, yet it swung strongly into a profitable position. Now, this is because the unit economics for eggs improved drastically, with raw material costs dropping sharply. Yellow maize and soya meal are relevant here and are part of the volatility in profitability for eggs, because these commodity prices can also move drastically in a given year, and those costs cannot always be recovered from consumers, especially in South Africa. If nothing else, the numbers from Quantum are a really great example of what happens when the unit profitability improves in a business, even if total revenue goes the wrong way. If you are losing money on something, there's little point in selling more of it. Sticking with the food theme, Bidcorp released an update dealing with the 10 months to April. Bidcorp is one of our very best corporate exports actually, with a business that makes money practically across the globe. If you want to see the US equivalent, check out a group called Cisco, that's SYSCO, with the stock ticker SYY. Bidcorp is not in the US, but it is in many other markets, which means the rand exposure in the group is minimal, and it makes it quite fun to compare to a group like Cisco. Now, having commented on Bidcorp's international exposure, it's worth pointing out that South Africa is one of the better performing emerging markets right now, despite all the obvious challenges. To give you a sense of how broad the exposure in Bidcorp is, they do also highlight markets like Malaysia and Chile as being good in this period. The developed markets are delivering for the group though, and that certainly helps, with Australasia, Europe and the UK all doing well, with the UK actually being the standout. Group sales achieved growth of 8.8% for the 10-month period, which is decent, although operating costs did deliver some pressure. Still, EBITDA margin before lease costs turned out okay, and whilst no HEPS guidance has been given, it does seem as though this will be a decent year for the group. Something they are very well known for at Bidcorp is bolt-on acquisitions, which means acquiring companies that are an easy fit with the rest of what you are doing. Instead of building an entire new structure of Lego, you're just buying some pieces to add to what you already have. Now, this has very much been Bidcorp's strategy in penetrating international markets, with DNA straight out of the Bidvest stable and the culture of acquisitions in that group. The update notes the completion of 2 bolt-on acquisitions, being a bakery in Germany and a seafood wholesaler in South Africa, along with a couple of potential deals in the UK and one in Europe that should all close within the next few months. Personally, I really love the fact that even with a global lens, Bidcorp still sees the opportunity in South Africa and continues to invest here. For all the pessimism that we find around South Africa, it really is important to read results like this and see that even global companies can find opportunity here. And now for dessert, another food business, this time at a different point in the value chain. Famous Brands has been absolutely left for dead by Spur in the aftermath of the pandemic. If we look over 5 years, which gives us a pre-pandemic base, then Spur is up more than 31% and Famous Brands is down nearly 40%. This is the impact of strategic focus versus a more diversified approach that includes businesses of varying quality. When managing through a crisis in the world, having simpler operations counts for a lot, and Spur is much simpler than Famous Brands. Famous Brands has now released results for the year ended February 2024, and they show revenue growth of 8% and operating margins declining from 10.6% to 10.1%. Headline earnings per share, or HEPS, that's down by 5%. Load shedding was certainly a feature of this period, and the company highlights that casual dining restaurants in shopping centres proved more resilient due to landlords providing backup power. Finance costs jumped significantly in the group, and I feel like they need to be putting more focus on where they allocate capital at a time when money is expensive. For example, the retail segment, that's products on the shelves at retailers, reported revenue of 368 million rand, but operating profit of just 6 million rand. It feels like that isn't an appealing model in this environment. They also need to find a way to get North Africa and the Middle East to profitability, with operating losses of 14 million rand after a loss of 26 million rand in the prior year. For me, Spur is just a much more interesting, focused and simpler story right now. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research and form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.